this is certainly a very interesting time for many investors. I mean, we haven't seen bond yields this low pretty much in modern history. Uh, that said, I mean, we've certainly seen it in the case of Japan and Germany, which we'll discuss in a moment. But what we wanted to do was take a deep dive into this whole topic of the role of fixed income and try to really ascertain, the relevance of fixed income in portfolios going forward. I think the most important reason why investors allocate to fixed income is because of the fact that they seem to offer ballast in a portfolio. That is to say that they offer very different risks than what's embedded in equities. And equities are clearly the most dominant risk in portfolios. Fixed income, traditionally, at least over the last 20 or so years, has delivered a very negative correlation with that of equities. When we actually take a look at fixed income historically, we think this is actually a very critical factor. The defensive nature of fixed income in portfolios is incredibly important and isn't only reliant on the stock bond correlation being negative on average. In fact, if we look at 9 out of the last 10 recessions, many of those recessions corresponding to periods where the stock bond correlation was actually positive, bonds consistently delivered positive performance. So we think that defensive nature in fixed income is extremely important. And certainly with yields today at around 1.5% on the US 10-year, they're much more defensive than they were at 50 basis points. The further you are from the zero lower bound, certainly the more that fixed income will display these defensive characteristics. But of course, that's not the only story. It goes much deeper than that. As we move on to the fundamentals in fixed income and we take a look at what's driving real bond yields, it's many of these macro trends that we don't think will change anytime soon. Things like demographics, as agents age in the economy, they certainly need to save more, creates a bid for fixed income. Other factors like the COVID scenario, which changed preferences of many agents, that results in a bid for fixed income as many try to actually build up their savings and rainy day fund to combat these sorts of severe scenarios. When we actually take a look at valuations, that's also quite interesting. Many would think that naturally equities would be the pivot in a portfolio to pursue as bond yields offer less in terms of return. But that, of course, isn't the whole story. When we look at valuation models, it actually says something very interesting. First and foremost, the relative value of equities to bonds. So when we look at the earnings yield on equities and we compare that to the real bond yield, that is actually in a very sort of suppressed state. And we'd expect, therefore, bonds to be quite cheap relative to equities, kind of in opposite to what many think. I kind of want to talk a little bit more about bond yields because bond yields don't tell the whole story. In particular, when yields are low, there's this kind of interesting thing that's happened in places like Japan and Germany. So what we did is we took a look at Japan going back to around 1998 when bond yields have been sub 2% ever since, and tried to kind of decompose and understand why the returns have been so high. They've been far in excess of cash, and in fact, the bond returns in Japan, looking at, for example, the 10-year Japanese government bond, has delivered somewhere on the order of 3 times the Sharpe ratio of equities. There I'm kind of referencing the Nikkei index as the relevant equity investment. When we take a look at Germany, we see the same sort of thing unfold. German bonds, so the 10-year German bond, has been sub 1% yield and since around 2014. And there, that Bund sort of return has delivered around 3 times the Sharpe ratio of what we've seen in kind of German equities as evidenced by the DAX. So there's this question of why the Sharpe ratio has been so high. Part of that, of course, is due to the denominator effect, the fact that risk has been lower. As yields drop, volatility has dropped as well. But that's not the whole story, as much of it is packed in the numerator. The fact that there has been an excess return above cash, that's been significant. So when you actually try to understand what's going on, you see that bond yields don't tell the whole story. Actually, the term premium tells you a lot around the excess return in bonds. So the steepness of the curve matters. So just to kind of think of it, if you buy a 10-year bond and you hold it for 1 year and sell it as a 9-year bond, and then reinvest in a 10-year, not only are you getting the yield on that bond for that 1-year holding period, but you're also getting the fact that you're rolling down the curve and the term structure may be steep. And so that explains a lot about the excess return on Japanese government bonds and German bonds. And interestingly enough, today, if we take a look at the steepness of the US yield curve, it's quite steep. So it's, the difference between the 2 and the 10-year yield is on the order of 120 basis points. And when you look at that compared to what was realized historically in Japan, the average curve steepness in Japan was only about 90 basis points. Active management, or the delivery of alpha in bond portfolios, seems to be quite consistent and substantial. We took a look at the Morningstar database and analyzed all bond managers in that database, as well as equity managers, and found that story to really play out. Equities, for whatever reason, active management has not really been rewarded over the past 10 to 20 years, whereas in bonds, it's been consistently sort of rewarded. So insofar as alpha is incredibly important, as beta returns have been somewhat constrained going forward, active management would seem to offer a key opportunity. Finally, you kind of want to mention that inflation is the fly in the ointment here. We haven't discussed inflation much, and should we go through a big inflationary episode, that would certainly be negative for bonds. So we'd certainly point the interested sort of client in that direction as something to investigate.